So you want to get started with this investing thing. You have some money saved, but you don't know what to do with it. On top of that, you're hearing stuff such as if you had invested 10 years ago in a Tesla stock, in an Amazon stock, or Google stock, this is the amount of money that you would have made. Also, when it comes to investment, there are so many options that you've heard of: stocks, ETFs, mutual funds, bonds, fine art, crypto, real estate, which leaves you completely confused. To add to these problems, you must have heard stories from your uncle or your dad who invested some money and lost money in the stock market, which puts an inherent fear in your mind that you might end up losing all of the money that you've saved. So in this video, I'm going to go over the basics of investing. This is a comprehensive video that I wish I had when I first started investing about 3 years ago. In order to make this simple and comprehensive, I'm going to divide this into 11 bite-sized pieces. Timestamps for those are down in the description. Let's begin with what actually happens to my money over time. If you've studied a little bit of economics, you would know that money loses value over time. This is due to inflation. Speaking of inflation in terms of coffee, the average cup of coffee used to cost about 44 cents in 1970 in America. The same cup of coffee now costs $1.70 on average. This is inflation in action. If you have to look at money, say you have $100 today and you stuff it under your mattress, you pull it out after a year, your $100 has now lost value. Take it all the way to 10 years, now that $100 looks $100 on paper, but in reality, it is a lot less. This is because all of this inflation compounds on top of each other, and so your $100 has lost a lot of value. If you don't understand compounding, be sure to watch till the end of the video because I'm going to cover it a little bit later in this video. This brings us to how to stop money from losing value over time. So let's just say we have a hypothetical savings account which is making us about 2 to 2.5% interest every year. So what this actually means is while the costs around you are increasing by 2 to 2.5%, your money is also increasing in value by 2 to 2.5%, which technically means that you are breaking even based on all of the cost increases that are around you. And your money maintains the value that it is supposed to in the current market. So how do we make money? Let's bring our hypothetical savings account back into the question. Only this time, we're going to say that it returns about a 10% interest rate. So if we invest $100 today in this savings account, over a year, it will return $110. 2 years from now, we'll make $121. This is exactly what compound interest is. And applying the rule of 72 to this, our $100 will convert to about $200.79 over 7 years. Now 10% doesn't seem like a very big amount. However, in the investing world, making a 10% return on average is actually considered to be a good amount of return. Now let's come back to reality. These kinds of savings accounts which return about 10% every year on interest do not exist in most parts of the world. Most of the savings accounts return you less than 1%, which technically means that you're still losing money over time. If you feel like this content is adding value to you, be sure to subscribe to my channel for more content like this. Section number 4 is what is an investment. So an investment is anything that puts money into your pocket with you having to do a lot less work. Now let's get a hypothetical scenario wherein you decide to invest in a property and you buy it for $100,000. You rent this property out for about $500 a month, which means you'll make about $6,000 a year. Now removing all of your mortgage payments, your interests, or any kinds of maintenance and upkeep that you have to do on this property, whatever amount is left over is your profit. Now let's just say you decide to hold on to this property for another 15 years before you sell it, and you sell this property for $200,000, which means that you've made 100% return on this property. The problem when it comes to real estate, however, is that real estate requires a lot of upfront amount, which most of us don't have. So to balance all of this out, an investment that actually allows you to start with very little money is in the stock market where you buy shares, which brings us to what are shares. A simple definition for shares is owning a part of a company, which means you give some money to a particular company that invests it into its operations, R&D, which helps it grow. And in return, you make a return, one, through increase in valuation. So let's just say we buy 10 stocks of Microsoft for $100 each. These stocks grow to about $125 over 3 years, which means your investment of $1,000 that you made 3 years ago is now returning you $1,250. Second way to make money through stocks is by investing in dividend shares. Now, what exactly is a dividend? Let's say you own Microsoft stocks and business is booming at Microsoft, because of which they've decided to issue $1 million as dividend. Now, you as an investor, if you say own 1% of Microsoft stock, that means you'll get about $10,000 out of the share of 1 million dividend. Although one thing to note about dividend stocks is that not every company issues a dividend. Some of the companies do it, and the companies which have been issuing dividends for a very long time, say for the last 10 years, can discontinue issuing dividends at any point of time. There is no written rule which forces the companies to continue issuing dividends for a lifetime. So how do you buy a share? You can't go on any of the websites for Apple or Microsoft or Tesla and then go in and buy a share. You do it through a broker. Back in the day, you used to have a guy that you used to call who used to be your broker. But nowadays, all of these brokerages have been moved online. Depending on the country that you live in and the kind of regulations that the country has, your brokers would usually be something like a bank would be one of the brokerages that you can use, or it would be a company like Vanguard. Here in Canada, I use Wealthsimple and Questrade as two of the broker accounts. Hey, just a thing, not sponsored, but if you don't have an account with Wealthsimple or Questrade, the affiliate links for those two are down in the description below. Sign up through those links and invest your first $100 to get a couple of free shares, and I get a kickback because of that. So what type of shares do I buy? As a beginner investor, I would say stay away from buying individual stocks. The reason is because you're adding risk to your portfolio. Sure, you can invest into companies such as Amazon and Apple and Microsoft because these companies have been around and maybe they'll exist over the next 10 years. But with you investing in these, thinking about that and putting it on a time, you're kind of increasing the risk on your portfolio. So for any beginner investor who is getting into the world of investing, some kind of an advice that comes down from all of the great investors that you've ever seen is some of the investing gurus or even Warren Buffett is to invest in an index fund, which brings me to what is an index fund. So there's two bits here. One is the index and the other is the fund. So a fund is something that is run by a manager. In this case, you as an investor invest some money and several other investors invest money, and this pool of funds is something that is used by the fund manager and he allocates it to buy either equities or bonds, etc., depending on the type of fund that you selected. In this case, the fund manager is the one that decides when to buy, when to sell, and his performance is actually dependent on how much return that he gives to you and to the company that he is working for. All you have to do in this case is just monitor your investments every now and then. Now, the second bit is the index bit, which refers to a stock market index. So in the US, we have S&P 500, which are the top 500 companies in the US. You have the NASDAQ 100, which are top 100 tech companies in the US. You have Dow Jones and so on. Similarly, in other countries such as the UK, India, and Australia, you'll have different kinds of stock market indexes. Speaking of stock market indexes, let's talk about the S&P 500, which on an average returns about 10% over the longer term. Conservatively, let's just say it returns about 7%. I, as an investor, although I started by investing in individual stocks, I have made sure that I have moved all of my or most of my portfolio into the S&P 500 now. And the reason behind doing this is that when you invest in an index fund such as this, your investment is diversified across a variety of industries. And in this case, this reduces a lot of the amount of risk that you can take. What this does is make sure that your investment is safeguarded than investing in an individual stock, which could go up or which would go down at any point. Speaking of losing your entire amount of savings or investment in an S&P 500 would be talking of a doomsday scenario, in which case the entire stock market or stock index has to completely collapse. If that happens, the money or the investment that you're holding won't really hold any value, and which is kind of a scenario which is highly unlikely to happen. Now let's talk about the risks. Chances are that you have a parent or a relative who invested some money in the stock market and lost all of it. And they have told you that the stock market is complete BS and it's very risky, so you should only save all of your money. Well, my take on this is there are only two ways that you can lose money in the stock market. One is if you make poor decisions, and the second one is if you panic sell. Making poor decisions in this case would be not buying the right kind of a stock, buying some of the hype stocks because some random person made some money on it and that stock was doomed to fail. Or secondly is when you panic sell. So let's just say you bought a Microsoft stock for $100. You kept monitoring it for several weeks, and then it kept dropping all the way to $87, and you decided to sell it. Well, if you had held on to that stock for a little longer and only ridden the wave, it might have returned you a return well over the $100 that you initially invested. So how do we avoid getting into this bubble and avoid the risk of panic selling and all of those aspects? Well, for any kind of an investment that you make in the stock market, you need to make sure that that investment sticks around for 5 to 10 years, because that is when it will return you a good amount of return than the amount of money that you have invested. So if you need any kind of funds immediately over the next 2 years, those kinds of funds should not be allocated at all into your investment portfolio. Now let's bring all of this within the S&P 500 context. If you go back in history for over 30 years or so, you can see that S&P 500, there have been certain bumps along the road. However, it has always pulled up and it has always performed better than where it was previously. So it may happen that you might buy on a high and then eventually it will drop to a little bit of a low where you might lose half of your investment. However, if you hold on to it over the next couple of years, you'll make sure that that investment is recouped and you earn a lot more on top of that investment. This brings us to when is the right time to invest. If you have questions such as when should I start investing, what is the right kind of age, and so on, the easier answer to that is as soon as you can. The younger you are when you're investing, the more or higher the chances that you have of reaping much larger potential returns over the longer term. Another thing is the younger that you are, you also have a lot higher risk tolerance, while at the same point of time, you also have a lot of time to recoup some of the poor decisions that you make along the way, while at the same point of time extending the amount of time in the market to get the type of returns that you need for your retirement. The older that you are, you may end up getting a lot more responsibilities. In this case, you might be thinking about your retirement with your wife, you might have your kids, you need to think about their futures in terms of their education, etc., which also leads to a lower amount of risk tolerance that you would have. However, one thing you need to know before you start investing is that you need to first get rid of any kind of high interest debts that you may have in terms of something like a credit card debt, because it doesn't make any sense here to make a return of 10% per year on S&P 500, but at the same point of time, you're losing about 19% to your credit card debt. And also, like the returns on the S&P 500, the gains that compound and give you higher returns, the losses of interest on the credit card debt also compound. So make sure that you're getting rid of any kind of high interest debt. So how much money do I need to invest? In the modern world, this amount can be as low as $5. Of course, it depends on your brokerage and the laws in your country. Somebody like a Wealthsimple allows you to buy fractional shares, so you can buy a fractional share even with $5. Click here to watch how you can invest your first $1,000, or watch another video on my channel. Like and subscribe if you haven't, and I'll see you next time.